Good morning, guys. Alibaba just released results, and let's dive right into them. So you can see that in pre-market trading, Alibaba is actually down 2%. So it looks like the market is kind of okay with the results. Not good, not bad, just kind of like in line somewhat. They might have missed on the top line from Wall Street expectations. Pretty much bang on with what I was expecting. Overall, results do seem good. And actually, in some areas, they seem better than what I was expecting. Some areas, they seem in line with what I was expecting. So let's dive a little bit more into them. That overall revenue growth is slowing, but it's growth nonetheless. And just from the main release page, you can see that I kind of called it when I said that they were going to take up their repurchase authorization. Notice that their repurchase authorization has increased by $15 billion. And that's really because they're buying up around $3 billion every quarter. And you can see just looking at the segments breakout, and I'll dig more into this in the full release, not in the first look, but you can see that revenue for China commerce has not declined as much thus far as I've predicted. And just recall, for fiscal year 2023, I was expecting revenue for China commerce to decline by 7.5%, due primarily to, the lockdowns, weakness in the Chinese economy, weakness in the global economy, etc., etc. And so I did put a summary up above saying what I just said. Overall revenue is doing much better than expected, and when you look at the bottom line, adjusted EBITDA, the margin of 30% for China commerce and 17% overall are exactly in line with how I've been modeling the year to come in. So I might have to increase my revenue expectations, which is actually a positive surprise. So if I'm forecasting revenue to decline by 7.5%, and I have to now take that up to call it a decline of maybe 3%, which might still be a little bit pessimistic, you'll see a change in my valuation. My valuation might go up from around $212 per share to maybe like $230, $240 per share. We'll see how this plays out. And I'll do a revaluation in the full analysis, which will come out later. And recall, this is where the model looks like right now. So you can see that total China commerce revenue is expected to decline by 7.5%. Look at that cloud segment. I'm expecting it to increase only by 10%. Cloud is actually coming in weaker than that right now. And overall total revenue, I'm expecting to decline by 4.8%. But I'm going to have to change these expectations. And just looking at the adjusted EBITDA expectations, which is in the model that the Patreons get access to at that lower tier. So subscribe if you would like to get access to this model as well. Notice that the adjusted EBITDA expectation for China commerce is around 30% for this year, and total EBITDA is expected to be around 17%. And you can see from the results that I just showed that they're pretty much coming in line with what I'm expecting, at least. Let me know what you guys are expecting for the end of this year. And you can see that on a 6-month basis, because I just showed you one quarter so far, for 6 months ended, the results on revenue growth and adjusted EBITDA margin are roughly the same. And notice that what are they doing with the cash that they're generating? Well, they repurchased $2.1 billion of shares this past quarter. So that's $1 billion less than what I was expecting. I was expecting them to run at approximately $3 billion a quarter, but because the share price was so low, the number of shares was roughly in line, if not higher. So this is what I mean about it being very accretive that they're buying back shares in this environment. And I, like many of you, would love to see the share price stay low for longer so that Alibaba can continue to buy up shares. And so what really has happened is they've repurchased 18 billion of their 25 billion shares under their authorization program. And so, as predicted, and in fact, it happened a little bit quicker than I thought it would happen, they've actually increased their share repurchase program by another $15 billion and extended the program through the end of March 2025. Look for this program to continue to just get extended and pushed out as time goes on, especially if the shares stay lower for longer and they're advantageously and accretively buying back more shares. Now, just diving into the segments a little bit, so you can see overall revenue for China commerce has only declined by 1%, as compared to the 7.5% that I was expecting due to the continued lockdowns and overall weakness. Adjusted EBITDA has started the year down 14%, but they've made up some ground with Q2 being up 6%, and so for the year it's only down 5% year to date. So it's very positive here. And what's causing that positive results? Well, this is what I've been talking about since their Investor Day. This is why it's very important to look at the Investor Day presentations, and of course I did a 10-part series on it. But notice that the increase in their adjusted EBITDA is primarily due to Taobao deals and Taocaicai reducing their losses as a result of improved operating efficiency. So these investments that they've been making to compete against Pinduoduo and JD.com are working. And so Tao Sai significantly narrowed losses year over year, driven by an optimized pricing strategy, enhanced sourcing capability, and lowered operation and fulfillment costs. So pay attention here and look for these two newer segments to continue to roll out and increase their adjusted EBITDA to the point where they start becoming profitable. I really wish that they broke these two segments out individually. I think in the year-end results they will. I hope that they just start reporting these results continuously separated from the remainder of China commerce. And now cloud growth is roughly in line with the 10% that I was expecting for this year, but it is a little bit slower at 7%. So I look forward to the segment picking up steam in the back half of the year. And you can see that they're still having the same disclosure, where that the decline in revenue growth is a result of them essentially losing TikTok. I think that's what that large customer is, as well as the impacts from the online education customers, as well as overall softening demand. So let's hope that cloud starts to pick up in the back half of the year. I do expect it to pick up. I expected year over year to increase by 10%, which is still weaker overall, especially weaker than the 37.5% that Alibaba expects for the industry as a whole in China to grow at a CAGR until 2025. So I'm looking for further disclosure here. And now overall, free cash flow generation has increased compared to prior year due primarily to higher operating income. So this is high quality growth. The one thing that I do want to point out is notice that they had a loss on disposal. So I'll dig further into that and see exactly what that non-cash item is. Ultimately, losses do become cash items because, I mean, you initially put in money in an investment and now it's not yielding a return. So, you know, you do want to understand what these are, even though it's a non-cash item on their sort of like cash flow reconciliation. But overall, you know, just straight lining the $8 billion for 12 months, you can see that the company's trading at approximately 12 to 13 times free cash flow per share. So once again, this is just a juggernaut that continues to generate free cash flow, and they're just buying back shares with all that excess cash. Now, of course, some segments did a lot better than I expected. Local consumer services, this is their delivery services, so think like Uber Eats, is actually up 21%. And Xinyao, which is their logistics segment, is up 36%. So I'm going to do a deeper dive into each one of those segments. So please hit that subscribe button if you haven't subscribed yet. Now, overall, my free cash flow per share valuation, which is net of stock-based compensation, might be a bit low. So what do you guys think that the free cash flow per share valuation should be? So I'm thinking that I might have to take this up to around 225, maybe 230, maybe 240. We'll see how this plays out. But effectively, what I'm saying is that the share price as a percentage of the valuation remains low. And to be honest, I hope it remains low because it allows the company to buy back more shares in an accretive fashion. And if we're long-term owners, that's what we're hoping for. Now, the other thing is, as I'm sort of thinking about the results, ask me all of your questions in the comments below. I'll try to address as many of your hard questions or interesting questions as I can. Also, if you disagree with some of my expectation on some segments, let me know. Some of you guys have been letting me know, and I'll highlight what you guys think and contrast it to what I'm thinking. And hopefully that'll provide a lot of learnings for all of us. So I'll leave it there, guys. But if you do want to see sort of my preview where I break down the segments in a little bit more detail, you can get to that video right here.